Hey, how's it going? Bill Leatherman here for Money Evolution. In today's video, we're going to be talking about why your group supplemental life insurance policy could be costing you a ton of money. So if you have one of these group life insurance policies, or maybe you're thinking about getting one, or you just don't understand really how it works, in this video, I'm going to be getting into all of the details. We're going to be talking about the advantages and disadvantages of a group life insurance policy. I'll be talking about how they calculate the premiums and how those premiums go up over time. And then finally, we're going to be talking about how you might be able to save a ton of money on your group life insurance policy by going through a hypothetical case study that saves nearly $14,000 over a 10-year period. But real quick, before I get into the content of today's video, if you're watching this and you want to learn more about what we do at Money Evolution, you can head over to our website, moneyevolution.com. There you can check out some of the financial planning programs that we have, and also our free resource library that covers almost all things financial planning, retirement planning, investing, and we're really trying to build that out into a great resource for individual investors and people that are preparing for retirement. So we'll put some links down in the description below for all of that. Okay, so let's jump in and let's start talking about some of the advantages and disadvantages of these supplemental group life insurance policies. So the advantages, really there's two big ones here. Number one is that they're just super convenient. You enroll right through your employer's benefit department, usually at open enrollment time, or maybe when you first sign up and join the company there, you have an option to get some of this supplemental group life insurance policy. The other big advantage of this is that there's no medical exam. So regardless of your health, if you're an employee of the company, everyone is essentially treated equally. And again, that's an advantage. It's also a little bit of a disadvantage there we're going to talk about a little bit later in the video here. But those two are really the big advantages of that. The money comes right out of your paycheck, so you don't have to worry about mailing in checks or going to visit an insurance agent to get signed up for coverage. It's just really easy to do through your employer. Some of the disadvantages, portability. So if you leave the company or if you retire, you may or may not be able to take that life insurance policy with you. Sometimes if you can take the life insurance policy with you, it's going to be at a higher rate because you're no longer an active employee, but sometimes they do have those options, and that's something that you definitely want to look into, especially if maybe you're going into retirement or something like that and you want to carry a little bit of that insurance for a few years. Portability is a really big issue there. It may be expensive. It may be expensive, especially for people that get a little bit older. We're going to talk about how these premiums are calculated, and they essentially have a table that they're going to reference for determining how much that life insurance is going to cost. And the older you get, just like with all life insurance, those costs are going to go up, and we're going to look at that. So they may be more expensive than a similar life insurance policy that you may be able to get outside of your group coverage. And there may be limits on how much life insurance you can actually get. Sometimes it might be 5 or 7, maybe sometimes as much as 10 times your base salary or your income, however they do it, but it's not going to be an unlimited amount of life insurance. So you may find that the limit on that group life insurance policy may not get you to exactly where you want to be as far as your overall coverage level. So it may be limited there a little bit. But again, the biggest thing here for these life insurance policies through the group plan is that they're just very convenient. Okay, so now let's look at how this is actually calculated. So up here on the screen, I have the IRS table that shows the monthly cost for $1,000 of group life insurance. And as you can see here, it's age banded. So depending on your age, you're going to have to find where you fall in this schedule here. And like all life insurance, it gets a little bit more expensive as you get older. So if you're in one age band now, as you kind of get older and you go into the next age band, that's going to increase your premium. So let's look at an example here. And let's say you're 40 years old right now. So you're in that 40 to 44 range, and it's going to cost you 10 cents for every $1,000 of life insurance coverage. So let's say that you're allowed to have up to 5 times your base salary, and let's say you're making $100,000 a year, just to keep our numbers relatively simple here. So that means you could buy up to $500,000 of life insurance through this group plan. So what we're going to do is we're going to just simply divide the 500,000 by 1,000. So we're going to determine that you're going to need 500 units to basically buy this life insurance. So 500 times 10 cents equals $50. So basically you're going to be paying $50 a month for that life insurance policy, or $600 per year. So again, when you're younger, these life insurance policies through the group plan tend to be very cheap, and most people probably aren't going to think a whole lot about something $50 a month coming out of their paycheck. But again, as you get a little bit older, that's going to start to go up. So once you get to 50, that number is going to over double. It's going to go from 10 cents for every $1,000 to 23 cents for every $1,000. And so that means your $50 premium at that time would go up to $115 a month. By the way, it's also going to go up a little bit there when you turn 45 as well, but $115 a month or $1,380 per year. And again, maybe you're looking at that, it's a little bit over $100 a month, $115. It's not really that big of a deal, but as you start to go up, you start to see, okay, now at 55, it goes from 23 cents to 43 cents. And then if you still carry that insurance at age 60, it doubles or almost doubles to 66 cents. It's definitely way more than double from where you started. So this life insurance, these group supplemental life insurance policies can definitely get a lot more expensive as you get older. So understand what that table is. This is sometimes hard to find if you are buying this group life insurance policy. It's probably just going to tell you how much that life insurance is going to cost right now as you're signing up for it, but it may be hard to find the table where you can see what that's going to be. And by the way, this is the IRS table. Your individual employer table may be a little bit different from this because it's going to be based on the group that you're in, whatever company you work for, and how healthy or maybe less than healthy the group is. And if it's less than healthy, these premiums could be a little bit higher. And if the group is really heavy, maybe you belong to a group of fitness instructors and that's your profession, so everyone's super healthy, maybe those premiums would be a little bit less than what we're seeing here. But you're going to want to take a look at this and know and understand what your table looks like and how much that cost is, not only right now, but also what that's going to be in a couple of years. You may sign up for this at 44 years old or 49 years old and say, hey, that's a pretty good rate, not really pay attention to it, only to find out that that rate is going up pretty substantially the next year when you reach that next bracket or the next level of the table there. Okay, so let's look at a hypothetical case study here. I'm going to erase all of this here, and we're going to look at a hypothetical individual, and we're going to just we're going to say her name is Sarah, and let's say that she is 49 years old right now. So she's in this bracket, and she's paying 15 cents for every $1,000 of life insurance that she carries. So right now on a $500,000 policy, we'll keep the numbers consistent here, she's paying $75 a month, so not bad, and certainly something that is pretty reasonable there. So that's $900 a year that she's paying. However, the next year, when she turns 50, that number is going to go from 15 cents to 23 cents. And instead of paying $900, she's going to be paying $1,380 per year for that. That's going to be that $115 a month that we were just looking at a second ago. And then it's also going to go up again when she turns 55. And that's where we see another big jump there. It's actually an 87% jump from the 54 year to the 55 year. So that's going to be $2,580 that she's going to be paying for that life insurance. So essentially, if we look at this and say, what if she were to kind of shop around? She's in pretty good health, and she might be able to get a good policy through a private carrier that might be less over this period of time than what it's going to be through the group plan. So essentially, if we just kind of leave out the year that she's in right now, the 49-year-old year, she's going to be paying $1,380 for 5 years between the ages of 50 and 54, and then she's going to be paying $2,580 per year for the ages between 55 and 59. So I got to reference my sheet here. So all of that adds up to $19,800. So a lot of times, this is true with, I think, all expenses as we're evaluating our plans. We might think of something that's a $50 a month. It's like those subscriptions to Netflix and Hulu and all of that. That all adds up. And especially if you look at it over a 10-year period, that's a lot of money going to insurance. $20,000 is not insignificant at all. However, if she shopped around and let's say she was able to get a preferred rate on a private life insurance policy, preferred would be the second from the best. Preferred best is actually what they call the top one usually, but a preferred rating, so she's in reasonably good health. She would be able to get, shop this around here just last week, she would be able to get a 10-year term policy for $600 per year. And because it's a 10-year term, that's going to be the rate that's going to be locked in for that entire 10-year period. So it's not going to adjust halfway through. So if we add all of that up and we subtract it from the $19,800, she would save $13,800 in premiums over that 10-year period. So it's a really big deal. So we've been working with a lot of clients over the years, and actually this probably came to me by accident, actually about 15, maybe almost 20 years ago. I had a client that said, hey, I was looking at my pay stub and all of a sudden my life insurance that I'm buying through work just really jumped up. And so I started looking into this and investigating, and insurance was something we kind of did as a relatively very small part of our business, and it wasn't really on our radar screen. However, this really drew it to my attention, so we started looking into it, finding out that this was a big deal and it was affecting a lot of our clients. And so if you're in pretty decent health, you don't have to be like superstar, marathon runner, weightlifting, 8% body fat and all of that. You just have to be kind of above average health of the group. And you really wouldn't know how healthy you are relative to the group until you apply for and go out to try to get a life insurance policy on your own. There's absolutely no cost or obligation to shop around for a life insurance policy. You're going to be asked some very simple questions, maybe a little bit of some health history and things like that. And then it usually would go through some type of a medical underwriting where they're going to get a little bit more exploratory, nothing super major or anything like that. But basically, they want to understand the life insurance company, how healthy you are. A big factor is going to be if you're a smoker or you're non-smoker. By the way, if you are a smoker, there's going to be a different table in your company too. So that's the only real distinction that they make on those group life insurance policies through work is whether you're a smoker or non-smoker. They don't even care if you're male or female. And on the private life insurance market, females tend to get a better insurance rate than males because females live longer than males. So it's, the only factor they're really using on those group life insurance policies is smoker or non-smoker. So anyway, if you're a non-smoker, you have reasonably good health, chances are you might be able to replace that group life insurance policy with something on the outside that could save you a lot of money. Now, if you we're buying $1 million or a couple $1 million through your group plan like many of our clients are, then that number of savings just really goes up. And it's really relatively painless. So once it comes back for medical underwriting, they'll come back and they'll say, here's your rating that we gave you. Maybe it was higher than we thought. Maybe you got preferred best, and so that rate would go down even a little bit more than that, or it was preferred, or maybe something else. But then you can decide, hey, I want that insurance or I don't want the insurance. And one very, very important thing to keep in mind is you never want to cancel an existing life insurance policy until you get the new life insurance policy in place because there's always things that could happen. Something could fall through. There's the underwriting process. And so you want to make sure that you are keeping your insurance up and don't drop that current insurance until you've already explored and you already got that other life insurance. You get the actual contract in the mail for that. But anyway, I wanted to make this video because this is something that's been coming up with a lot of our financial planning as we go through a very exhaustive financial detail to get into not just the retirement parts of it, but also, what are some of those other things that are going on, helping people calculate refinancing and life insurance and all of these other things, creating retirement income strategies. So anyway, again, I'll put it down there again in the description below, but if you want to learn more about any of that stuff, you can check that out. We have a page that we're setting up on our webpage that is going to be all about life insurance. This is just a video that we made about the group life insurance. There's a lot of other factors too, talking about how much life insurance you actually need. And oftentimes as you get older and you start to build your portfolio assets, get closer to retirement, the need for insurance oftentimes goes down over time. So you may not need as much life insurance as you think you do, but there's only one real way to do that is to kind of run through some of those exercises. But we got some great resources on our website that can help you with all of that, and then also with the retirement planning and all that. So anyway, I hope you enjoyed the video, and if you do, hit that like or subscribe button, and I will see you back in one of my next videos. Thanks.